now, because it is going to be a lot about that in today's trading session. Abhishek is here to run us through the numbers. Abhishek, on first look, it looks quite mixed. How would you look at these?
Well, Pavitra, to begin with, it's a mixed bag, but more on the good side, rather than being negative, because this was priced in that the merger impact will be there on the P&L. To begin with, slippages at 7,800 crore. Annualized slippage ratio is 1.34%. That is for the merged entity. In the previous quarter, HDFC Bank alone, the annualized slippage ratio was at 1.44%. Asset quality has improved. Gross NPA ratio has come down to 1.34% versus 1.41% in the previous quarter. Now, the NII, that's a miss on our poll. It has come in at 27,385 crore. We were working with a number of 28,190 odd crores. That was on account of rise in cost of funds and the ICRR rule implemented by RBI, which had a 25 basis point impact on the net interest margin. Now, PAT has come in at 15,976 crore. We were working with a number of 14,616 crore, largely led by two key factors that, there was lower provisions this time around and lower tax rate also, which actually held the PAT this time around. Net interest margin, that has come in at 3.4% of total assets. In the previous quarter for the bank alone was at 4.1%. Management had guided anywhere between 3.6 to 3.8% kind of a level. X of the one-off that you have from ICRR, it is around the 3.6%, so it is at the lower end of the guidance. ROA, that's the best part, it's being maintained at 2%. Even for the standalone bank, it was at 2.04% in the previous quarter. The risk weight asset to advances, that ratio has come down to 93.3%, and for the bank alone in the previous quarter it was around 103.4%. so a mixed bag, but not too negative. Back to you.
All right, and it'll be interesting to see how the street reacts to that, right? Because the stock has already corrected a lot this year. Abhishek, thanks a lot for running us through all of those numbers. Like Abhishek was pointing